All right, so we're going to talk about job order costing. So last week, just a little recap, we talked about three areas of costs that we need to track. Do y'all remember what they were? Want to try to
Variable
guess?
cost
What was that?
is one of them variable cost.
No.
Like opportunity cost, and differential cost.
No, think the first word direct for two of them. You remember
Direct labor cost,
direct labor is one.
cost,
Direct material, direct labor,
and conversion
and what was
cost.
that last one?
Is it conversion cost?
No.
Manufacturing.
Manufacturing overhead.
Like I think I came up with something.
So we let me see if I can scoot this over. I'm gonna try it real quick before we start. I want to see if I can bring up my grid with everybody on it so that I can see more. Okay, so again, just like last week, when we start into the chapter, you can stop me and ask questions along the way. You don't have to wait till the end. Just unmute and, you know, and then just kind of cut me off and ask me. That's fine. I'm okay with that. Okay, so tonight we're talking about job order costing, and those three things that we just mentioned: direct material, direct labor, manufacturing overhead. So we're going to be looking at that again and following it through into a job. So job order costing is looking at a big job, and it's going to bring in those costs, and you're going to track them. All right, so the job order costing systems, when do we use those? So when we have a lot of products that are produced for each period, or we have products that are manufactured to order, so maybe it's a big item, and then something unique to the order that requires changes, something that's different, and you want to track those costs and allocate them to the job. So that might be another reason why we would do that. Examples would be a big aircraft, an airplane, possibly a construction company. They have a particular job at a construction company that would have lots of aspects to the construction job itself. Maybe there's, you know, different build outs in different rooms and different types of equipment that are going in and different materials. Sometimes we have those little nuts and bolts and, you know, wires, and sometimes we have bigger pieces that go in. Construction could also be doing, you know, flooring, wood, anything like that. So you would keep track of some of those items on how many are actually going into that job. So you're pulling out all of the pieces that are going into the construction. So you're not manufacturing something, but you are putting together something. And then Walt Disney's another one with the movie production. They also will have job order costing. There's going to be one particular job, obviously a movie that they're working on, and they're going to want to put all of the costs into that, so they know how much it costs to produce this movie. And then, you know, figure out how were they profitable after, you know, the production, and they put it out into the movie theaters. So I put some other ones down at the bottom. So accounting firms also will do the same thing. So they'll have clients, and whenever it's so accounting firms are not a manufacturer, obviously, they're just a service, right? So the accounting firms are providing a service for their clients. Well, even in that, if you have, you know, a particular company that you're doing books for, and you're doing taxes, or maybe you do an audit, whenever you have people working on that particular client, they're going to get costed to that particular client's job. So they will have job order costing as well. Construction companies, AV companies. So I worked with an AV company, which is very similar to construction in a way. So there's a lot of different pieces that are going into a job and things that you need to look at. You also want to do some analysis, because you want to know, you know, what did I estimate that it was going to cost me to do this job? How much on labor? How much was the materials going to be? Materials sometimes are a little easier than trying to estimate labor. So somebody's got to design a job. Then you have to have people go out and actually put the equipment in place. And are those people trained? Is it taking longer than what you estimated? Is it, not maybe as much? So there's a lot of things to look at when you have job order costing. So I'm very familiar with that when it comes to like a construction type company. All right, so let's look at direct materials. So we talked about direct materials. And direct materials are those items that we can go, we talked about raw material, right? We have inventory. We can go into that, that department and say, we need this product. We need these parts. We need this material that we can pull out of that department in order to use on our job. So those are very easily traced. And you can say, okay, I'm using this much wood on this job. I'm using this much aluminum on this job. And so you're costing it out. And usually you'll see it in a few minutes. We're going to go through like what the paper logs used to look like, but everything's different now that we're using the software. So we'll go through some of that. I'll talk about it when those come up. And then there's direct labor. So you have people that you're using on these jobs. And so you have their salaries, their hourly wages that are going to be costed into that job. Okay, I have 5 people that are out on this install that are working on this construction site, and I'm going to have to cost all of their labor to that one job because that's where they are. Maybe they've done 2 jobs that day. They've gone from one to another, and so half the day would be costed to one job, then the other half would be costed to the other job. Again, they're very easily traced. That's the key with the direct materials and direct labor. It's very easily traced. So that way you can get it onto the job. So we have that, and then we have that manufacturing overhead. So last week we talked about sometimes we have those direct, indirect materials, indirect labor, people and items that are going to be allocated. Sometimes they're fixed. So we have to look at those and figure out how are we going to come up with an amount that we're going to allocate to the job to cover those costs, because we want to make sure we include those in. Okay, so here's one of those job cost sheets. So back before computers, they would have these logs, and they would log their job numbers and put their materials on there, who was working, how much, how many hours that was, and they would have an estimate for their manufacturing overhead. And so it would look something like this, and they would fill it out as they go. And this is kind of what it would look like, with the materials. It's showing you, okay, here's some material. This is what we're pulling out. We're costing it out to job A143. This is the quantity, the cost, and it tells us how much goes on there. So now that we have a software that is able to do this for us, normally what's happening is you'll go into a department, somebody is there that can pull the actual equipment for you. A lot of times they'll go into the system and they'll have a list of inventory, and they'll say, okay, I want this, this, and this. And there's a way that the system can assign it a job number. That job that you assign usually is already set up. And that way, when they go to cost it out, they can just pull it and put on that job and then print you out a report and say, okay, here's all of your equipment. It could look like a packing slip. It could look something like this, where it gives you the actual cost. It doesn't have to show the cost on it. Sometimes you don't want that information given to certain people. So maybe that's just internal in an accounting department, or maybe a purchasing department, or a project manager is looking at this. So if we have anybody that's, going for project manager, you may see these types of requisitions. But instead of being on these little sheets that you have handwritten, they're coming out of the computer system. Somebody's actually going in, selecting that, putting it on here. And then now a lot of times with labor, so we have to figure out a way to cost out that labor. So here it is on the sheet for the material, but we may do something in the computer. Okay, so here's the time ticket. So maybe in the, before they had a time card and they would have to log in, or maybe you come in and you punch in on a time clock. I don't know if anybody's working right now that has an electronic system, but I know here where I'm at the mall, we have maintenance people that work, and they are able to go and log into the system using their finger. They just go up to the thing, put their finger in, they know who they are, And so then nobody can clock them in or out or, stamp a time slot. It's a little bit more secure than that now. So now those employees could be going on their phone and they could say, okay, I'm here at this job site. I have the ability now to select the job that I'm on. And then you just stay there until you leave for that day. Maybe you're there all day. So in this particular case, they're there 8 hours. And on this card, it has the hourly rate. So the people that are keeping track of the costs, usually in accounting, are looking at the employees, and those employees are tied to an hourly rate. That is going to pull over onto the job. So in the system, it's keeping track of what's happening in the materials, with inventory, what's getting pulled, and that job's being selected. It's looking at who's clocking in and putting this job number, and the system already knows internally how much those wages are because everything's already set up. So everything's being tracked into the job very easily through the accounting system that you have. So here's our little costing sheet. So we have our materials, the cost of the materials. Now we're showing our hours, our direct labor hours. We had 8 hours at $36. So it's $120 total. And then so far we have 2 pieces, right? So at the bottom, it's got the summary showing the material, showing the labor. Now we've had some form of allocation set up for the manufacturing overhead. Well, we want to look at that for a minute to see how would we come up with something like that. So just keep remembering that there's 3 pieces: your direct material, direct labor. Those are very easy to trace. Those are going directly to the job, and those amounts are easily calculated. With the allocation base, sometimes we have to figure it out. Maybe they gave it to you, but maybe they don't. So let's look at that. So we have an allocation base, such as maybe direct labor hours, labor dollars. It could be machine hours, something that is used to assign the manufacturing overhead to the jobs. So the allocation base, it can be impossible or difficult to trace overhead. Then we have the overhead that consists of many different, ranging from grease that are used in machines. We talked about wiring, some of the wires that we pull out, they're on big spools, maybe little nuts and bolts. And so some of those are not as easy to track. And then we have manufacturing overhead costs that are fixed. So remember, we talked about things that maybe if we're in a plant working, that we have those overhead costs for the manufacturing plant that is paying rent, and that we have electricity. So we have some of those that are going to be fixed. All right, so when we calculate what is the amount that we're going to use for the manufacturing overhead, it's something called a predetermined overhead rate. The reason why it's predetermined is usually we're coming up with a number based on estimates. So we're going to be estimating what do we think the cost is going to be for this production? What do we think the cost is going to be for this job? Whatever it is, whatever that total cost is, that's our estimate. And then we decide what's the allocation base. What are we using? Is it, machine hours, labor hours? Is it units? So something we're estimating, we're going to know what is that total. So all of that has to be given to you in order to calculate it. And then once we have it, we can put it into this formula. So the predetermined overhead rate just means the estimate of the total cost over the estimate of the allocation base. And we're going to do an example so you can write this down so that you remember how to do it, but we will go through an example to show you how that works. Okay, so predetermined overhead rates that rely upon estimated data. They're often used because the actual overhead for the period is not known until the end, right? Well, we can't know how much was our actual cost, right, for this year until we're finished. I don't know, how much the expenses were on my different buildings that I have until I'm finished the year, because I don't know how much, is going to happen. Maybe something happens to my roof and I got to fix it. That wasn't in the budget. So you don't know that until after you actually go through a job or go through a period of time. So that's why we're estimating, and we're using sometimes we're using previous years, sometimes we're using what we think is going to be, what's going to happen this year. What do we think the costs are going to do on materials? And so we're doing our best educated guess in order to calculate an estimate. So the actual overhead costs sometimes fluctuate seasonally. And so sometimes that can mislead decision makers. So especially right now, maybe last year you got quoted for a job and the cost maybe has increased, 20% this year over what you were estimating it last year because of inflation. So sometimes that happens. So if you know that things like that are coming, you can sometimes prepare for that and, put that into your estimate when you're calculating that. All right, so the predetermined overhead rate is computed before the period begins using the 4-step process. So remember, we're doing this before, it's predetermined. We're coming up with an estimate. So we have 4 steps. So we're going to estimate the total amount of the allocation base, which is that denominator. We have to decide what we're using in order to come up with that estimate, okay? Then we're going to use the estimated total fixed manufacturing overhead for the coming period, along with the variable manufacturing overhead. So we talked about that formula last year. It's a mix. We have a mixed cost. Sometimes we have fixed and some variable costs based on how much we're producing. So we have to estimate that. That's our formula right there. We got that estimated cost over the estimated allocation base. So we have to know both of those things. And then number 3 is that we want to use the equation to estimate the manufacturing overhead. All right, so again, we went through this last week. The Y is the total manufacturing overhead cost. Okay, that's using both that fixed and variable. So A would be your total fixed manufacturing cost, plus you want to add that variable cost in there. So we have the estimated variable manufacturing overhead cost per unit, and then the estimated cost of the allocation base, and you multiply those together. Add them up, and then you get your predetermined overhead rate. Okay, do y'all have any questions about that predetermined overhead rate? Do you understand the 3 different pieces that we're pulling into a job? No questions? Because we're going to look at an example real quick. Okay, so let's look at the overhead.
I'm sorry. So the 3 costs were not the cost. It was direct labor and I forget what were the other 2?
Okay, so yeah, so you have 3 pieces that are coming in for your total cost. Okay, so you're going to be a direct material, direct labor. Those are easily traced. We talked about those. That's the actual material pulling in. That's the actual labor hours that are being worked. And then we have to calculate that manufacturing overhead. That is the 3rd part that's coming into the cost. And so this
overhead.
Yeah, okay. So this example that we're getting ready to do is your predetermined, we're figuring out the predetermined overhead rate. This is your manufacturing overhead cost that you're going to use to estimate for the year for those jobs. Because we have to come up with something. It has to be an estimate. We're not actually pulling anything at that time. We don't know what it is in advance. So we have to do a predetermined overhead rate. All right, so parent company estimates that it will require 160,000 direct labor hours to meet the coming period's estimated production level. So our allocation base, we're going to base it on labor hours in this example. So remember the formula, it has the total cost over the allocation base. So we know that the 160,000 direct labor hours is going to be our denominator. Okay, then in addition, the company estimates a total manufacturing fixed cost of 200,000 and then the variable cost of 275 per direct labor hour. So our formula, Y equals A plus BX, you just plug those numbers in so you can come up with the total. So we have 200 fixed for A, plus we have 275 per labor hour, and how many labor hours were estimated? 160,000. So we just multiply that and then add it to the 200. So we have a total cost of 640,000. That's my predetermined overhead. Okay, that's what I'm expecting. That's my total hours for my predetermined overhead rate. So my 640,000 in total cost divide it by that allocation base, which is direct labor hours, 160,000. I'm just dividing, and I'm coming up with $4 per labor hour. So when I'm doing a job, I know that every labor hour that I'm putting on that job, it's $4 per hour, in addition to the amount of wages that I'm paying for those hours. Okay, so you see it's two different things. So even though I'm using the labor hours, it doesn't mean that I don't calculate the direct labor hours of the worker. The worker is still getting added in through that direct labor. In addition to that, I'm estimated on labor hours. So I'm taking this manufacturing rate that I'm coming up with for that overhead, $4. And all I'm doing is saying, okay, I'm just going to estimate that by the direct labor hours. This makes sense to me. Sometimes it may be a different allocation base. It may not be direct labor hours. It may be machine hours. But in this example, we're using direct labor hours. So just know that that can change. And if you see that it's direct labor hours, don't get confused that it's not both. It is both. You're going to use direct labor for the wages, plus you're going to use the amount of hours to calculate this number per hour. So now you have it costed in using direct labor hours for both. So on this example, we used 8 hours. The 8 hours is multiplied by the wages for the direct labor, and then it's using that predetermined overhead rate, same amount of hours, in order to calculate the manufacturing overhead. So we're just saying 8 hours times the $4. That gives me $32. That's going to get added in. So there's my 3 pieces: direct material, direct labor, and then my manufacturing overhead. So right here at the bottom, those are going to get added up to get me my total cost. And we can also get some more information off of this. If you see, we got how many units we produced, so we can figure out how much is it per unit once we know the total. All right, so now we're going to look at computing the total cost and the unit product cost of the job using the plant-wide predetermined overhead rate. All right, so back to the card. There's our total: direct material, direct labor, manufacturing overhead. There's your 3 pieces. We have our total cost of $268. Units completed 2. So we're just dividing it by 2 to come up, what is it per unit? So we have 134. So do y'all have any questions? Because that's kind of bringing it from start to finish on the job costs. Okay, no questions. All right, so we'll go to an example. All right, so we have job number WR53 at Northwest Fab, Inc., requiring $200 of direct material, 10 direct labor hours at $15 per hour. We're estimating a total overhead for the year of $760,000 and an estimated direct labor hours of 20,000. So we don't have to calculate anything like we did before, because they're just giving us the numbers. They're telling us what the cost is. They're telling us how many hours. So we already have those numbers to do our predetermined overhead rate. Okay, so what is the cost that needs to be recorded? So let me see. I think I might have to select a pen, but let me just see. Okay. So what do we have for direct materials? It tells us right here, $200. So we're going to have 200 for direct materials. We have direct labor, manufacturing overhead. So we want our 3 pieces. So now we have our direct labor hours. So it's saying we have 10 hours at 15. So 10 times 15. So what's my total here? So I have 150. Then it says my overhead. So this is my total for the year, the 760 and the 20. And we remember how we have to do that. We take the total costs divided by the estimated allocation base, which is labor hours, to come up with the number of the predetermined overhead rate, which is 38. So now, because we're basing it on labor hours, I need to use those labor hours again, 10 times, instead of 15, that's my wage, I'm using my predetermined overhead rate, which is 38. Okay, so that's going to give me 380. That's my three pieces. So do we understand this part here? It's already given to us. We just plug it into that formula. We figure it out what it is per hour. And then how many hours did we use on this particular job? It's only 10. So now we're taking 10 times the rate, which is $38, to come up with the manufacturing overhead. So it's not hard. It's just a few steps, and it's just a little bit to kind of understand this piece on why are you calculating this. And if you can understand that, I think that this should be pretty easy to figure out. So now my total is $730. So that's how we figure it out. Okay, so that's my three parts that I need to, three sections that I have to bring in for my cost: direct material, direct labor, manufacturing overhead. No, if they don't give you this, you may have to calculate it out, but they gave it to us. So now we can just figure out what it is. Maybe sometimes they won't even make you do that. They could say your predetermined overhead rate is $38. So then you just have to look at it and say, okay, I'm basing it on direct labor hours. So I'm going to take the 38 and multiply it by the 10. They would have to tell you they use in hours. Okay, and there's the work. Oops, sorry. Okay, so now we have job order costing, a managerial perspective. So inaccurately assigning manufacturing costs obviously is not good, right? It can adversely influence the planning. So if you don't have the right cost in there, the decision that you make could be wrong. This is why whenever I have class, I always say it's important when you're in the field and working to try to get your numbers as accurate as possible. If you're, doing project management, you want to make sure that you're calculating the right materials are going to the right jobs, making sure that those guys that are on the jobs are making sure they put the right job numbers in. And you'll be surprised, how many times people are putting the wrong job, or putting material to the wrong job, and that can influence things in a negative way. So you want to make sure that that the information that's going in is good, so that the reports that are coming out are useful. If it's garbage in, it's garbage out, right? So if you don't have good information going in, we won't have good, useful reports, and that happens on occasion, and you have to work through some of that. Okay, so now we have job order costing system that can accurately trace direct materials and direct labor costs, but job order systems often fail to accurately allocate the manufacturing costs during the production process. Maybe we decided to use labor hours, and that really wasn't the best way to allocate. Maybe we should have used machine hours. So it really depends on what you're producing, what kind of manufacturing you're at, or how are you trying to calculate that predetermined overhead rate. If it's not really something that's close to how you should do it, then maybe you're not getting the right numbers. So you have to look at that, depending on where you are and what type of business it is, in order to make decisions to try to figure out what's best. So there are some issues with job order costing when you have to allocate manufacturing like that. All right, so choosing the allocation base. So remember, that's that bottom number. Sometimes it's labor hours, sometimes machine hours. So we have to determine how are we going to use that? How are we going to allocate? So the job order system often uses allocation bases that don't reflect how the jobs actually use overhead resources. So we just talked about that. Maybe we chose the wrong one. So the allocation base and the predetermined overhead rate must drive the overhead cost to improve job cost accuracy. We won't get a good, accurate costing system if we use the wrong allocation base. So a cost driver, that's what they call it, is the factor that causes the overhead. And then we have many companies that use single predetermined plant-wide overhead rates to allocate overhead costs based on the usage of direct labor hours. So sometimes that's too simple and you don't get good, accurate cost driver, because maybe it's not the same across the whole plant. Maybe using direct labor hours may work in one area, but not another area. So that's why it's saying sometimes it's oversimplistic. And then we have the, more than one overhead that can be identified and we may use different ones, multiple predetermined overhead rates, and that could help us be a little bit more accurate in our estimate. All right. So compute the total cost and the unit product cost of a job using multiple predetermined overhead rates. So we just did one with labor hours. Now we're going to look at an example that has two different departments and they allocate differently. We have Dickinson Company. They have two production departments, the milling and assembly. So the company uses a job order costing system and computes a predetermined overhead rate in which the product department, the production for each production department. And then we have a predetermined overhead rate in the milling based on machine hours. So we have milling that's going to use, let me see if I can get my annotate, draw. So the milling department, they're telling us that we're using machine hours. Assembly department, we're using direct labor hours. Okay, so we have two different departments allocating using two different allocation bases. And then it says the company uses cost plus pricing and a markup of 75% of the total manufacturing costs to establish the selling price for all of its jobs. So they do this at the beginning of the year. And the company made the following estimates. So remember, it's predetermined. So I'm looking at my milling department. This is an estimate of how many hours I think that it's gonna take to do this job or these jobs. It's gonna be a total of 60,000 machine hours. It's gonna cost $390,000, and that variable overhead is going to be $2. Assembly, same thing. I'm estimating on my direct labor, it's gonna be 80,000. I have 500,000 in total costs. 375 is what I'm saying is going to be my variable overhead for direct labor hours. Okay. Didn't change. Okay, so let's look to see how we're going to calculate. So during the current month, the company started to work and started and completed job 407. I wonder if I can get rid of these. I didn't realize these were going to stick on here. All right, so I don't have to write the calculation because they give them to us. So we're going to look at the milling department, and it says 390,000 plus. Remember, that's my fixed. So if we go back, let's see if I can go back one. So here's my fixed. The 390 and the 500, it tells me on this screen. That's where those numbers are coming from. They're giving them to me. That's how I have those. Okay, so I have 390,000 and 500,000 as my fixed. So for the milling department, it was $2 per machine hour because I'm basing it on machine hours. So I'm doing the same exact thing. I'm just going to do it twice. So I have 60,000 and then I multiply it, add 390, I come up with 510. Then I have my assembly department that has a fixed cost of 500,000. I'm going to add that to my variable cost and direct labor hours. So I just multiply those together, add 500,000 to it. So I come up with a total of 800,000. So I have my numbers for the milling department and the assembly department, total of 510 and a total of 800,000. Okay, so here's my totals right here. And how do we calculate that predetermined overhead rate? Remember the formula. We're going to take the total cost, the total estimated cost, and divide that by the estimated allocation base. So for milling, it's the machine hours. And for the assembly department, it's those direct labor hours. And this comes right off that chart that we looked at on that first screen. So once we calculated the total cost for each department, we can do this now. So we have the milling department with 510 total costs divided by our allocation base of 60,000 hours gives me 850 per manufacturing, per machine hour. And then I have 800,000 divided by 80,000 direct labor hours, which gives me $10 per direct labor hour. So for the assembly department, you know, depending on how many hours you worked on that job, I'm going to not only have my wages for my direct labor, but I'm going to have, again, those hours used to calculate the assembly manufacturing overhead and multiply it by $10. Y'all have a question? Okay. You know, I forgot to open the chat. Does anybody know if their chat is open, if anybody has put anything in there?
There's nothing in it.
Okay, thanks. Just let me know if something pops up. Let's see, I just opened it. I'm gonna put it to the side. Okay. All right, so next we want to calculate the amount of the overhead that was applied. So we're going to look at this job. So we're calculating for job 407. So we have a total machine hours for 407, tells me 90 machine hours. My direct materials, my direct labor hours are here. And then it's got my direct labor costs on there. My assembly department, it's listing out my machine hours, my direct labor hours, direct materials, direct labor costs. So we have to figure out those three pieces that we need. So first we have to figure out how much is it for that overhead. So we calculated that it was $850. If you go back to that previous screen. Okay, here it is. So my milling department's $850 and the assembly department is $10. We just calculated that. So that's what they're using. That's where those numbers are coming from in this calculation at the bottom. So I'm saying for milling, I'm using, go back to my pen. I'm using 90 hours because I'm going by machine hours. And then for the assembly department, I'm using my direct labor hours. So I'm taking those numbers that I just calculated on the previous screen and multiplying them by those numbers to come up with my manufacturing overhead costs. So I have 90 times 850, which gives me 765, 20 times $10, which is $200. So what were the other two pieces that we need? We have manufacturing overhead, but we also need what? What are the other two pieces? Somebody?
Direct labor.
Direct labor
Materials.
and direct materials. So remember, those are your three. So we have our direct materials given to us. And then we have our direct labor given to us, and we're going to add them all up. All right, so here's milling, direct materials, direct labor, manufacturing overhead applied is 765. So you saw where that came from, right? We just multiplied. It's right down here, these totals, 765 and 200. Okay, so we have manufacturing applied, 765. The assembly department, we just pull our numbers over. Direct material, direct labor, manufacturing overhead was $200. And if we wanted to know the total for each one, we could look at that and have how much was the total for milling or assembly. But we want to look at this total job cost and see how much was it for job 407. So we just add them together. So it's doing the same steps. We're just doing it for two different departments. So it's not really difficult. It's just mainly making sure you understand the steps and where the number's coming from for your manufacturing overhead. All right, so when we add them together, our total cost for job 407 is $2,485. So remember, they gave us another piece to this problem, which was now we want to sell it, right? And the markup is 75%. So now we have to figure out what is my sale price, you know, for this job. So we're going to look at that. Come on, mouse. It's not letting me do the mouse. Let's just erase this first. It's not letting me erase either. So something happened. And now I lost my menu altogether. Here it is. More. Nope, that's not it. I lost my tools. All right, well, I got it to change and they went away, so I'm not sure what happened. And I'm not sure I'm gonna be able to write because I don't know how to get my tools back. Oh, here it is. Okay. All right. So for calculating the selling price, remember they told us that we're going to assume a 75% markup. So we have total job at 2485, and then we're going to multiply it by 75% to come up what is that markup. So this is the markup right here. And then the selling price of the job becomes 4348.75. Okay. So it says it's important to emphasize that using a departmental approach to overhead application results in a different selling price for job 407 than it would have been using a plant-wide overhead based on either direct labor or machine hours. So basically it's just saying it's different. Well, of course it's different. You know, if we decided that we were going to use a plant-wide overhead, we would just be using one allocation base. Maybe it was the machine hours or maybe it was the direct labor hours. But because we've chosen to look at each department separately, now the selling price is different, the cost is different because we're allocating different. So that's all that's saying, is just that, you know, when you use different methods, you're going to have different amounts. So the appeal of using the predetermined departmental overhead rates is that presumably provide a more accurate accounting of the costs caused by the job. So again, we want to be accurate. And sometimes that means we have to look at each department separately in order to have a more accurate report for us to make better decisions when we're planning. Okay, so if you're in the marketing department,
can you tell your sister to get off?
I think that was not for me. Hang on. Okay, I'm not sure. I can't ask to. It won't let me ask to mute or mute, and so I'm not sure how to do that. Okay. So anyway, if you are in the marketing department and you're getting ready to market these this equipment or product, and the company uses a terrible allocation and it causes the cost of this product to be really high, and they want a 75% markup, well, maybe it's overpricing. And so you're working for an organization that you're going to be out marketing a product that you're never going to sell because it's too much. And so your livelihood is based on commission. Well, would you want to work for a company like that? Probably not, because if you're not selling, you're not making money. So, you know, you want to make sure that if you're in marketing or if you're in sales, that you're working for a company that's doing a good job at coming up with an accurate cost, you know, that is going to be the best cost in order to come up with a reasonable sales price. You can't sell it if it's unreasonable. Okay. All right. Multiple predetermined overhead rates and activity-based approach. So we're just going to talk about this for a minute. We have a chapter later in the semester that we'll talk more about activity-based costing. So when a company creates overhead rates based on activities that it performs, it's employing an approach called activity-based costing, which is an alternative approach to developing a multiple predetermined overhead rate. So we're not really going to get into how to calculate activity-based costs, and we're just talking about it right now, but you will see that later in the semester. So instead of using that predetermined overhead rate that we just learned, we're going to be looking at a different method, which is called activity-based costing. All right, so job order costing for the financial statements. So the amount of overhead applied to all jobs during the period will differ from the actual amount of the overhead incurred during the period. Okay, so what that is saying is, in the beginning of the year, when we came up with that estimate that we were going to be using for our overhead, it's not going to match what the actual is. We know that. We try to get it as close as possible, but you're going to have actual costs, and sometimes it's different. And so we're going to be looking at that sometimes at the end of the period, sometimes throughout the period, to see where we are in order to make decisions if we need to make changes. But when a company applies less overhead to production than it actually occurs, it creates something called unapplied overhead. So unapplied means that we didn't put enough overhead, right? The actual is more. So we have
So,
unapplied.
I'm sorry, I don't mean to,
No, go
interrupt,
ahead.
but like, so basically overhead in this context is basically just a projection
Right,
in a
so
way.
we're
Yeah.
looking at a comparison right now. Like on this slide, it's talking a little bit about a comparison between what was our estimate for that overhead versus what actually happened. And this is very common. You can look at it on jobs, or you can look at it plant-wide, at the end of a period. And so we used to do this at the end of jobs when I was in the AV company, because we were estimating materials, we were estimating the cost of those materials, we were estimating how much materials were being used. We were also estimating how much labor hours we thought it was going to be. And then at the end of the job, you go in there and you start looking at it and you're like, oh, I'm estimating that it's going to take these guys 1 day to do this job, and it took them 2 days. Well, then you're like, you made a mess. But when you have an overhead for a plant, you are looking at that a lot of times on a bigger scale, because you're estimating for that period of time, which could be 12 months. And so you want to look at it and compare it. So that's kind of what it's talking about. So if the company applies less overhead to production than what was actually incurred, that means I estimated the overhead to be the $4. And I'm using that to, I'm going to calculate that by direct labor hours. And then I come up with a total cost. And so my total cost was $50,000, but yet my actual cost that I incurred for overhead was $100,000. Well, then I'm $50,000 off. So it's just saying I underapplied to my cost for the overhead because I didn't put enough in. And then it's vice versa. If maybe I overestimated and I came up with an allocation of $100,000 that I've costed to the job, and the result, that just means that I've overapplied it because I have too much. My actual is less. Does that make sense? If y'all could make sure you're on mute so that the background noise don't come through. Okay. And then the financial adjust for the overhead applied. So the cost of goods sold reported on a company's income statement. We talked a little bit about the income statement last week, and a little bit in the review that we did. We look at what was the cost of the goods, and the cost of goods sold means that now that it's, it's an item that has a cost on it and I've sold it. And so I have to pull that out. And so when I pull that out, I'm pulling out an inventory, I'm costing it to a job, that's deducting from how much I sold it. You want to make sure your sales are more than what the cost was so that you're making money. Well, the cost of goods sold reported on a company's income statement, it has to be adjusted to reflect that over or under. So remember, we talked about the estimate sometimes is over, but the estimate sometimes is under as well, right? It's over or under. And so we want to make that adjustment. When we make the adjustment, this slide's basically saying that we can take the adjustment and put it into the cost of goods sold. So we're not going to leave this variance between the two at the end of the period. We're going to do something with it. So if I underapplied, then I have to increase my cost of goods sold. So maybe at the end, my cost of goods sold is, $50,000. I sold my product for 100. But I underapplied it. So now I don't have a $50,000 profit anymore. I have to go ahead and put that, the additional cost that it actually costs. I got to put that in. Maybe it's $20,000 more. So instead of making 50, now I made 30. But you're doing an adjustment in order to remove that variance. So now I'm increasing my cost. Well, it could be vice versa. So maybe I have 100,000 in sales and my cost of goods sold was 80,000, but I overapplied. I estimated way too high. My costs are lower. Well, now I can adjust for that. So at the end, I'm like, okay, well, let me do my adjustment. I'm going to decrease my cost of goods sold. So what does that mean? It goes down. So instead of 80, maybe now it's 50. And so instead of having that 20,000 in profit, now I have 50,000 in profit. So it affects, your bottom line, depending on what your estimate is. You will never be able to estimate exactly, right? There's always going to be a variance. And sometimes it's a really bad variance. Sometimes it's an okay variance. Sometimes it's, over or under, but not a lot. But know that that happens. And you try to get, companies will try to get a little more accurate as they go. Sometimes they'll change their method if it's not working properly. All right, so now we're back to our job cost sheet. So all of the company's job cost sheets collectively form the subsidiary ledger. So if you have a software that handles job costing, you won't have these little sheets, but you will have a way in the software to print the items that are on a job. So you can pull each job separately and it'll show you all of your material, all of your labor, whatever those manufacturing overhead was that you estimated, all of that will show up on a report. So, and it should look something similar to this, where it shows you what the product was, probably the quantity, how much was it. You may get a little more detailed in this sheet. And then you have your direct labor hours. You may be able to run reports on how many guys were there and what were those rates when you're looking at the hours that people worked on a job. And then for the manufacturing overhead, you'll have all of your estimates for the year. You're basing it on hours. And so then you can look at it. And then you're looking to see, in the end, I had all these jobs and this is what it was. And how did we estimate for the year? Do we need to make changes? So all of this is looking to see what do the management have to do in order to make a decision for the company to be profitable or the company to be a little more efficient in their costing process so that they can be more accurate, right? That's the goal. So that's why we have these sheets that give us all this analysis. Then we have the balance sheet reporting. So the job cost sheet provides an underlying set of financial records that explain what specific jobs comprise the amounts reported in the work in process and finished goods. So we'll talk about that a little more later. We touched on it last week that when we start jobs, we don't always finish the production in that month. So sometimes we'll pull some raw material out. It goes into that work in process bucket, which is on the balance sheet because it's an asset. We're going to be using that for the future to come up with our finished goods. So that's an asset. And then we have our finished good inventory. So we have some products that are finished that we haven't sold. Just because we, start a month doesn't mean we're going to start it, we're going to finish it and sell it all in the same month. It's very rare that that happens. Not that it can't, but it's rare. It's a process that you have to go through. So it moves from that raw material into the work in process, into the finished goods. And you should have a way in order to see what is my work in process? Where am I on my jobs? And so I will be able to pull at the end of the period all of the jobs and I can see which ones were completed. I can see which ones have some material in there. Maybe they have a little bit of labor in there, but they don't have manufacturing overhead yet. They're in process. They're not complete. And then I should be able to pull an inventory list to say, here's my finished goods. And all of that shows up on the balance sheet. But inside the software, there's going to be multiple reports to get all of that information. The financial statement's only going to give you a number. It's not going to break down all of those jobs. They're showing you job cost sheets here because that's how they used to keep track of it when they had the ledgers like this. But in the system, you'll be able to pull reports or maybe even see on the screen all of your different jobs that you have. All right, so the income statement reporting. So we have the job cost sheets that provide the underlying set of financial records that explain what specific jobs comprise the amounts reported in the cost of goods sold on the income statement. So again, when you're looking at these jobs, you can run reports to see how much was the cost of my material, my labor, my manufacturing overhead, and what did I sell it for? And you should be able to see the difference. And so when they're talking about the financial records, it could be just a report that's showing you that. How much was the cost of goods sold on this particular job and what did I sell it for? Anytime you're fooling with income and cost, that goes on the income statement. Anytime I'm looking at products, materials, inventory, things that are that are still in my company that are going to benefit me in the future that I can use later to make money. That's my assets. That's going to be on my balance sheet. So that's what we're talking about. The job itself, work in process, finished goods. Those are my assets. And then on the cost of goods sold side, that means I've already sold the product. So now I want to see what is my income. So I can look at my income versus my costs versus my expenses. Okay, so this is basically saying we're focusing on the manufacturing applications, but job order cost systems can be used in service industries, which I did touch upon a little bit in the beginning, because I talked about how lawyers, accountants, like when you have a service industry, they will also use similar job costing because they have people that are working on that particular client and they want to be able to bill the client based on how many hours did it take, how many people had to work on that particular job to get it done. So law firms do this, accounting firms do this, anything that provides service, they want to know, you know, how long did you spend on that? It could be designing a website. It could be, you know, some kind of marketing piece for a client. Well, when, you know, you pricing out a job, you may need to know how many people is it going to cost, you know, me, how many hours to complete that website in order to get what the client wants. So you need to know an estimate of what you think your costs are going to be. So this is just basically saying this job order costing thing isn't just for manufacturers. It can be for service type companies. And I just gave you some examples of that. And that is the end of chapter 2. So do we have any questions? Everybody is ready to go out and do some job order costing? Not everybody at once. Y'all are not very talkative tonight at all.
I don't have any questions right now, but I feel like it's just moving a little fast. I
Felt
think
like it was a lot.
practicing or like homework. Yeah, it was a lot. But I got it. I hope.
Well, so yeah, do the questions and the homework and then we'll have example problems of what I expect you to know for the test. But you know, going through little example problems like we did in the presentation, you know, that's what I'm looking for, or the type of, you know, questions you have in the homework. I try to bring in things that you know, I think is important, that's going to be useful for you in the future. Yes, almost Friday. Somebody wrote in, no questions, all good. This one says almost Friday. Close to the weekend. Okay, so if you have any problems during the week, feel free to email me, but keep in mind if it's something, again, that needs to be addressed right away, go ahead and send me a text message. Let me know that you emailed me or text me your question because I don't always check it every day. I try to do that more like when we have testing and stuff, but just in case, you know, we've been really busy at work, so I haven't been checking the emails during the day. I've been pretty bad with that. So make sure you text me. My phone's here in my office and I usually have it with me in meetings. So just send me a message so I can get with you. If you feel you're having any difficulty understanding something, just let me know so we can try to address it before we get to, you know, the test. All right, so if there's no questions, comments, we are done. Y'all have a good weekend.
All right, thank you. Have a good night.
Thank you. You too.
Thank you. Good night.
Good night.